So I'm going to throw this up here. This is the 18-year property cycle. So the 18-year property cycle was put together by the economist Fred Harrison. Now, he looked over 300 years of data here in the UK talking about what's happened in property. And a number of things has came out of his studies of the economy through that timeline is that he has identified an 18-year property cycle. And of all the cycles, it's probably the one that's most accurate than any other. So let's unpack this a little bit. Now, when we look at the 18-year property cycle, understand there's 4 phases. We've got the recovery phase, as in recovering from a market crash. There's a mid-cycle dip. Then we go through an explosive phase before we then get back into another recession. Now, let's look at this in a couple of ways first. Notice that the start of the recovery phase, and by the time that we go all the way back to recession, the next recovery phase starts significantly higher than it was back here. So, in premise with that there is, if you overpay for a property, remember that property that we paid £98,000 for? It was only worth £85,000. Now, as we went into a recession, we get hit the hardest because why? We overpaid for it already. And that property ended up dropping to value of only £75,000. But that didn't happen overnight. We bought the property in 2008, and it wasn't until 2011, going on to 2012, had the property dropped down to 75,000. Now, if we only paid market value of 85, it wouldn't have been that much of a drop. But it was more significant for us because we overpaid. So keep in mind, how you buy property at the start is important. So we'll get into that as we go along. But we need to also understand that the property market is very different from anything else. Stocks and shares, crypto, other asset classes like that, very volatile that we've been talking about, and you can see drops of big percentages overnight on a daily basis, on a weekly basis. So in September 2008, when Lehman Brothers literally shook the whole economy by closing its trading floor, and then that sparked a knock-on effect to the likes of AIG and many other big companies that just started to fail and go under. And through that whole process at the end of 2008, well, here's the crazy thing as well. Northern Rock had already failed here in the UK before that, right? So through everything that happened in 2008 that led us into the last big recession that we had, it was already on the cards through 2006 and 2007. But it was really starting to take full effect in 2008. So one of the things that we need to understand is that when we go into a recession, we really start to feel the worst of it when you're probably halfway through it. But it doesn't feel like you're in a recession when you're actually in a recession. This is going to make sense as we go along. And this is where it catches so many people out, because so many people think a recession is going to last way longer than it actually does, when on average, it lasts around 4 years before it starts to recover again. In the last recession that we went through in 2008, last big recession, and we'd overpaid for this, and I started to aggressively be building my portfolio during that period of time as well, because again, all I knew was if I buy right, it doesn't matter. Like, I wasn't thinking about a recession. I never understood truly what it was. I already never had money, so it was like, welcome to my world, everybody, right? When you never had money, it's not like it's going to really affect you. But as we know what happened in 2008, going into 9, 10, many businesses started to struggle. Many layoffs started to happen. People became unemployed, and it could have been significantly worse if it wasn't for the government stepping in and having government stimulus, quantitative easing, which is printing more money. In the UK, £500 million of money was printed during the last recession at 2008 into 2009. And that was to prop up the market. That was government bailouts of a lot of companies. The Royal Mail and many of the banks were bailed out. So off the back of that there, that stops the economy got into an even deeper recession. So arguably we could have been a lot worse off if it wasn't for the government's intervention of printing more money. But that also creates a problem too, doesn't it? So what happened off the back of that is we started to see a recovery phase. And in the last mid-cycle dip, where I can relate that to is everything that happened with Brexit. Because when it all came out, which was, oh, the UK is going to exit Europe, that's going to be a disaster. So what happened during that period of time? Property in London started to drop. The rest of the UK started to become a little bit stagnant. But things were most affected because of London and surrounding areas, because that's where a lot of international money comes in. So international money started to slow and not come into the UK as much. And that's where we saw a mid-cycle dip. Now, anybody who's thinking about getting involved in property during the last recession, they'd have been saying this to you: property prices are going to get worse, don't invest in property. And then what happens? We're going through a recovery phase, then there's a mid-cycle dip. All those same people, guess what they're saying? I told you so, it's going to get worse, don't buy property. Well, lo and behold, what happened after Brexit was what came into play, that we're going to be exiting Europe. And then we had the year's extension before it was going to happen. And then what happened once we exited Europe? Nothing happened. Nothing happened. In fact, the exact opposite. More money came pouring back in to the UK, and we went through an explosive phase. Now, that arrow there, or that line, shows an explosive phase like this. But here's what an explosive phase actually looks like. It's more like that. It doesn't look like this. There's this illusion that during an explosive phase, every single year is always higher than the previous year. No, because an explosive phase is an average about 7 years of growth. And when you go through that, there is little times where the market contracts and pulls back. Some years you start seeing a lot more, and it's normally towards the end where you see a lot more growth. Because during the last explosive phase that we have gone through, we've had COVID and everything happened with the global health crisis. Now, if you spoke to any of, like, Bank of England, Savills, Knight Frank, HBOS, like all these different lenders, banks, and I guess valuers, they all said as we went into COVID that the market would drop as much as 17%. Do you know how much the market dropped during COVID? 6. No, it went up 16%. The exact opposite, it went up. Now, off the back of everything that happened during COVID, then we need to look at the knock-on effect of that. Because when we had all the lockdowns that we had, then what happens off the back of that? Production levels start to drop, don't they? So, but why? Because people are not working in a warehouse, are not manufacturing more things. And then, because of all the lockdowns, we had more government stimulus. Another $500 million in the UK was basically printed. And that was in the form of grants, furloughs, bounce back loans, CBIL loans, all of this here to try and stimulate the economy. And the crazy thing is that everybody who was now on furlough, getting paid not to work, or doing limited time and getting paid more, then the reality is most people were not going out, not spending money on fuel, not going out on the weekends, not going on holiday. They had so much disposable income and more money getting poured in. So what did everybody start to do? They all became investors, investing in crypto, investing in stocks and shares. And most people became what? Amazon addicts. Started buying everything you could possibly imagine. Luxury goods went through the roof because everyone's buying luxury goods. Like we had Amazon deliveries almost every day coming to the house. Like it just became bored, so I need to buy stuff, right? Everyone wanted to do home improvements. Everyone wanted to like landscaping and doing gardening and having outhouses and everything. Gym equipment for your house. Like it's nuts what happens that when you're locked down, stuck in your house, the things that you took for granted, now you want in your house. Commercial took a lot of an effect as well. Now we've got this hybrid living in a sense for a lot of companies still in terms of working from home, you name it. So off the back of that, with printing more money, and the problem being is not enough production. And that caused what? That's what's caused inflation over the recent years to spiral. And that's why, through all of that, the property market's been doing this. That's why property market was going anywhere between 10% increase, 15% increase. It was just increasing. And then that's what happens when inflation starts to spiral out of control. Because if inflation starts to spiral out of control, cost of materials cost more, cost of living goes up, and if the cost of materials costs more, that gets put onto the price of a new build home. So that's what pushes up the values of properties and all that stuff as well. So there's two things to deal with inflation that's starting to spiral out of control. One, tell me which one you think would work best. There's one option, which is the government stepping up, whoever's in power at the time, saying, look, you guys are all spending so much of your money just now. I know we've given you all and everything else as well, but can you just rein it in a little bit? Can you just stop spending as much? Can you just chill a wee bit? That's the first option. Or it could be the second option. We're just about to go into recession. It's going to be an absolute disaster. We've got cost of living crisis. Things are spiraling out of control. There's going to be a lot of, pullbacks. We're going to have to, cutbacks and not put as much money into the economy and everything else that we're going to do. We're about to go into recession. It's going to be a bit of a disaster. The narrative needs to change in order for us, because as soon as you start to see that we're going to go into recession, or you hear that, people start going, oh, we're going to go into recession. Is that true? Well, what's one thing to force that? There's only one other way to get inflation under control, and that's to do what? Start to increase interest rates. Now, arguably, interest rates should have increased far sooner than they did, but didn't because of COVID. That meant interest rates get kept low. We have been spoiled with low interest rates for far too long. So then what happened off the back of cost of living got spiraling out of control and everything that's going on in the world, right, which has an effect on that, especially from COVID and, everything that's happened with Russia and Ukraine and, oil and gas prices, you name it. So as cost of living starts to spiral and salary increase is not at the same level, we have a cost of living crisis. So you need to change the narrative. So as you start to increase interest rates, now cost of borrowing costs a lot more money, so people borrow less money. People start to contract a little bit. Businesses don't go and borrow more money because it's costing them a lot more, so they contract a little bit. And you see the knock-on effect that starts to happen across the market. So when Liz Truss announced with her mini budget that there was going to be tax cuts and everything else, to the tune of 80 million, she never had a plan, because the UK was going to have to go and borrow more. She never had a plan, or she never announced a plan on what that was going to be, which meant that then had a knock-on effect on the markets, and the markets reacted badly, as in, oh my God, the UK is going to default. How are they going to be able to get through all of this? And because of that moment of madness, when she could have just kept her mouth shut, never even called for a mini budget, just wait, but she tried to make a statement, that shook the market. Bank of England had to step in because our pensions, you guys got a pension in here? I don't know if you know this, your pension. You might think it's not yours. No, I'm talking about your pension. Came this close to just vanishing. I know you're sitting there, like, not comprehending what I'm saying. I know you're sitting there going, no, my pension. No, your pension. Everybody's pension. How scary is that? That close to just disappearing if the Bank of England didn't step in and shore up the pension companies until there was some calm to the marketplace in order, because everybody was about to pour money out of the UK. That would have been catastrophic. And that's why rapidly we start to see Bank of England base rates starting to increase. And the reason why it increases, then everybody who starts to see those increases, what do? We contract. Because things are going to cost a lot more. And that there is all the talk of going into a recession. Here's the crazy thing when it comes to property though. Do you know what the definition is of a property market crash? It's a 10% drop in price over 12 months. Do you see how ridiculous that is when you look at that against any other asset class where you see 10% swings on anything, literally on a daily basis with stocks and shares and crypto, sometimes significantly more. But property, because it's slow to respond to anything else, is over a 12-month period. Now, over 2023, property in terms of the market contracted. We started to see a small drop. We started, as in a few percent. And that's what you hear in the news. Property prices are dropping significantly. It's going to be a market, 2 or 3%. Do you see how everything's been magnified a lot bigger than it actually is? And that's been a narrative. And because the Bank of England base rate's gone up, everybody during all the Liz Truss debacle was just crazy. People were just, again, were freaking out, thinking about interest rates were going to go up to 10, 12, 15%. Everyone freaked out. It was a knee-jerk reaction. The markets always settle. The markets always settle. As in now, so yesterday it was announced for the 6th consecutive month, interest rates are staying at 5.25%. So as interest rates start to stay as it is, as in time, then what does that do to the market? It starts to calm the market a little bit. It's just been announced this morning that the UK is no longer entering into a recession because it's seen, ready for it, 0.6% growth in the last quarter. Like it's almost crazy how we all freak out and panic about insignificant percentages in the grand scheme of things. So in order to be classed to be in a recession, you need 2 consecutive quarters of decline. So the reality is this whole talk of us going into a recession, it's not yet. Now, just so you know, it's coming, but it's not yet. And it's not for a few more years. Not only with the interest rate starting to stabilise as it is at the moment, off the back of that, you're going to start seeing most likely interest rates starting to be cut. So when interest rates start to get cut, what does that then do? Cost of borrowing is a lot less to borrow. That stimulates the market a lot more. People borrow more money, right? Now, we could have a change in government here in Scotland with a Labour government. In fact, in the UK, with a Labour government. If that does happen, do you not think that they might start making a statement in the sense of calling for helping first-time buyers and residential mortgages? What's that going to do? We still have more explosive growth to go through over the next couple of years. And why is that to be true? Well, we need to look at fundamentals. So forget everything that's going on in the news just now. Let's look at fundamentals. Fundamentals is all about supply and demand. Back in 2008, we had oversupply of property. 2008 recession to now is very different in terms of the market. We don't have oversupply. The numbers have been updated from the numbers that I used to share, which was 350,000 shortfall of homes in the UK. It's now been revised to 550,000 homes a year is what we're behind in terms of building new homes. Like, when do you ever see a to let sign? You just don't. That's why when a property comes up for let, the letting agent goes, I've got 300 people on my books that would rent that property. We have a massive housing shortage. And because of that, and we're not building enough homes, that's going to do what? Supply and demand is going to continue to drive up prices. The only thing that stopped the market over 2023 was the concept of interest rates continuing to go up, and that's why things stagnated a little bit. Still was going. I mean, already we're into May, and this year property prices are up by 6%. This year. We're only at May. We're not even halfway through the year yet. So understand, whatever the narrative is, it normally takes a year or two before it translates into the market. And why am I sharing this? Because we have been taking advantage of the market over the last 6-12 months to be aggressive of buying property. Like, understand that we cannot stay stagnant because of whatever's happening in the mainstream media and whatever everyone else is calling out and saying. The same people, so right before everything that happened with Liz Truss, when the market was signs of it just going like this, Properties in Edinburgh were selling 15, 20, 25% over home report. Crazy. If you had talked to anybody, they'd say, no, don't buy property, wait for it to crash. So, property started to stagnate, started to go down. Everybody's telling you the property's in a recession, a crash. Where's all those people that said not to buy property? Are they buying property just now? I can already tell you the answer. The answer's no. So we need to stop listening to people who are not informed, who don't understand property. You need to learn for yourself and learn from those who do understand the market. So here's what we need to look out for, because that's the next phase. That's the next phase. So we need to take full advantage of the market that is at the moment with the right strategies, because you can still get great opportunities. You can still make a lot of money the way the market is right now, and that's the premise of today. And then we're going to be better prepared for what's coming. So here's what we need to watch out for. We need to watch out for the supply and demand ratio to change. Now, we're not going to build enough homes quick enough. So what's going to have to happen in order for more stock to come on the market? Unemployment. More and more people no longer having a job in order to the situation they go, I need to sell my home. And they put the property on the market to sell. And that doesn't happen overnight. That takes years. It takes years. So understand right now, we have more jobs being advertised than there are unemployed people. There's more jobs being advertised than there are unemployed people, which means if you're unemployed, you're either unemployed for two reasons. One, something means that you can't get a job or whatever that may be, and there's a reason for it, or you're a lazy bastard. Simple as that, right? So only two reasons why someone would be unemployed right now. Because there's more jobs available than ever before. Now, here's the key here. It's unskilled labour. Once unskilled labour gets replaced or lose their job, then skilled labour can go anywhere else to get a job. Because they're skilled, they can go and get a position elsewhere. But unskilled, then what happens? The government need to step in. They need to support unskilled labour, which means they need to spend less money on infrastructure, less money on NHS, less money on new green deals and energy efficiency plans, because there's only so much money. And if they're having to support people because they can't get work, that means less spending, which means what? The market contracts, means a lot of businesses don't have as much money getting spent just now. And off the back of that, then people start laying off people, and you see the tipping point, and then what starts to happen. So we're nowhere near that happening just yet. So wouldn't it make sense for us in here to understand how we intelligently invest through any phase of the property cycle and understand that we've got more years of an explosive growth to really go out there and get some great deals under our belt, make money, build a property business, because the inevitable is going to come. And do you know what's crazy for me during the last recession? Many people found themselves in an unfortunate situation when they had to sell their home. What was once their home, their asset, became a liability. And for me, there was nothing so, I guess, fulfilling for me, and this is going to be crazy for a lot of people, to be able to help people that when you're able to buy a property from them, they turn around and say to you, thank you. I was in an awkward situation I got myself into, and you were able to help me out of it. There's this idea that us landlords just go and take properties from people. It's far from it. Most of the properties that we buy are properties that people don't want to live in. They're run down in poor condition. That's the ones that we want to add value, to renovate it, to then go and rent it out or to sell it. And of course, people who overstretch and need to sell their house, if you've got more strategies, which we're going to talk about, you can help them. So if you change your approach, you can help people through various challenging times. Help them get what they want, but at the same time get what you want too. So we need to take a very different approach to what's going on in the market, and that's being informed and make sure that we intelligently invest ourselves.